captures everything. So profitability is wrapped up in there. Moving on to tangible book value. This one's more of, it's thought of as more of like a floor for bank stocks. So when a bank stock reaches, when the stock price reaches the price of their tangible book value, which is the value of their equity, minus intangible assets over their common shares, that's the tangible book value per share. When the stock reaches that price, the value of the equity would be the same as the value of the stock, so it should not go any lower than that. So it's viewed as kind of a floor whenever, I guess, during the downturn, for, I guess, Ozark would be a good example, when they lost so much market cap. One turn price to tangible book value was kind of a floor for the stock. It creeped a little bit below that, but it was a good support level. So in times of like credit stress, people start looking at the price tangible book value ratio a lot more often. But one thing to consider there is, in the prior example, whenever a bank had to eat into its capital because of the loan losses it took, whenever you get rid of your equity on your balance sheet, your price tangible book value is going to change. You have less tangible book value on the balance sheet, so that will affect the valuation as well. So banks typically, a lot of people look at this one particular profitability metric, your return on your tangible common equity. That's your net income over your tangible equity. And they kind of regress that against, build out a regression graph with all the peers in it to determine, I guess, where a bank sits at. And typically what you see is the banks that are returning the most of their tangible capital, they're also trading at the highest tangible book value multiple out of the group. So that's one thing that's less subjective than earnings, just because it's your equity. Your equity doesn't fluctuate as much as your earnings, I don't guess.
It's a larger number.
Yeah, it's a bigger number as well. So I think there's a couple more slides left. I'm boring you guys. I think you might be asleep right there. It's all right. I was there not too long ago.
He just graduated a year and a half ago.
I graduated not long ago. Yeah. So these are just a summary of kind of a few different things that we look at whenever we're starting off high level looking at banks. I think I've talked about most of these just going through the presentation. Your margin, your return on assets, your return on tangible common, your efficiency, how much operating leverage you're driving. Your credit quality is huge. The liquidity you have on your balance sheet, your capital, are also two really important metrics to look at. A lot more subjective, and this is kind of you can't put a number on this one, but like the markets that a bank operates in. That can widely affect valuation as well, just depending on people's feelings of the market at that point in time. Typically because banks have real estate in the market that they're in, they're lending, unlike Ozark's example where they're lending in Miami, banks are typically lending to real estate in their markets. So if people have a bad view about, are you guys from Nashville? Anybody from Nashville? A lot of people think Nashville's really hot. These Nashville banks, Pinnacle, First Bank, people might have calls thinking that they lend all in Nashville. Nashville real estate's hot, so there's a bubble there. So that's one it's not tangible. You can't put a dollar figure on it. You can't put a dollar figure on management quality, but that's another very important metric. You're looking at a stacked management team, or you're looking for a stacked management team, a handful of people who've been in the industry for a while. Most of these guys that run the banks that we look at have done this for 40 years. They're now CEO, CFO, COO, the Chief Credit Officer position. Some of the newer CEOs and CFOs that are in the industry, their banks don't trade at high of multiples. That could be for various other reasons, but typically it's because they're trying to get their feet on their own. Last one, I would be kind of remiss if I didn't just touch on M&A. M&A is a huge factor in the bank industry. You've seen a huge amount of deal flow the past couple of years. This is something Stephens does as well. Jay Brogdon, who is a Harding alumni, is one of the bigger investment bankers in the regional bank industry. So these transactions in the Southwest, most of these took place in Texas. Jay Brogdon, Harding alum, did a significant portion of these deals for these companies. Everyone at Stevens has a lot of respect for that guy. But M&A is definitely an investable theme. You see a lot of investors keying in on who's going to buy a bank, who's going to sell their bank. So there's a ton of speculation on who's an M&A seller, who's buying. And it is an investable theme because in M&A, you typically, when you're purchasing an asset, for the seller to get rid of that asset, you're going to have to pay them a little bit more than it's worth. So there's usually some kind of premium to the stock price, that's what makes it an investable theme. Those multiples have come in recently. You see like the red line right there is the price multiple of the transaction. That's come in recently. So people are starting to focus on it less, but it's still a pretty big factor. I think I touched on these in the presentation, but these are kind of 3 trends that people have been talking about recently over the past 2 months. Investors from every hedge fund shop, New York, Chicago, LA, all the big shops, they're worried about the path of the Fed, what a bank's exposure looks like in terms of asset sensitivity, like we talked about a little while ago, the shape of the yield curve and where that's headed, which I will not give any views on. I have no idea. I don't think anybody else does. And then probably the biggest one that we've been most vocal on is credit, where we are in the cycle. Particularly, we've been trying to flesh through a lot of data to figure out what banks are exposed to what types of lending, just aggregating data for clients there. Those are 3 of the big topics right now. I'd be glad to take any questions from you guys or who else.
One big question I have, and this is probably not relevant to the group that you cover, but virtual banking. When you look at, like we looked at Bank of America and how many thousands of branches that they have. And I'm wondering if you're a Capital One or a new banking organization that's focused more on virtual banking, I would think that if you have a lot of brick and mortar, that your return on assets and hence your return on equity would get hit really hard relative to a virtual bank. Is that something y'all talk about or look at, or is it not that big a deal for y'all?
If you have as much brick and mortar, your ROA is less?
Yeah,
okay.
Because you've got so much more invested.
I see what you mean here.
Yeah.
Not always the case, because it's pretty interesting. There's kind of a trade-off there. These brick and mortar banks can bring in cheap deposits. The online banks, the people with the online presence, the only reason that I would go and bank online is if someone pays me 2.5% on my checking account right now, because I can't walk into any bank down the road and get that same rate. So I think it's Neiman, or is it Marcus? It's Marcus by Goldman. That new online platform, Citi's got one, I'm sure. JP has a huge platform. Usually the money, and especially some of the Capital Ones, they pay a lot more for their deposits. They don't get any free checking. They don't give out free checking. So your profitability is hit from that respect. So it's usually kind of offsetting, and even more so where these online banks typically are less profitable, because what they don't make up in funding, they lend out.
Is that a generational phenomenon? Because you've got older people who say, I'm not putting my money in an online bank, but people your age wouldn't have a problem doing that, would they?
Yeah.
People my age, who are less educated, for example, they're like, I don't see the bank, it's not there. I'm not putting my money there.
Yeah.
But is that?
I would say it's a huge generational thing, and it's something that's one of the really interesting and very hard to pin down long-term trends people have been looking at, is what kind of money is flowing into online platforms. Is that going to accelerate as the population ages and the millennials become the new baby boomers? Yeah, it's a huge trend right now, something people are focused on. it's kind of in the back relative to what the Fed is doing, but
Right,
it's something that will start to take up more and more space.
yeah, and we're still looking down the road.
Yeah.
We might be 5 or 10 years away from that, but the challenge, what you're saying, the challenge the virtual bank has is to lower that cost of funds.
Yeah, to lower that cost of funds, and then also to get higher yielding assets, because a lot of what they do is buy securities.
Ah,
So they don't lend out all of their money. A lot of these online banks don't. You still earn a spread. If you're lending out money at 250 and you're buying securities at 350 or 450, you're making some spread, but you're not making the 5% spread that a regional
so
bank
their
is.
loan to deposit ratio is much lower than a
Yes,
virtual bank.
yeah, correct.
Interesting.
I'd also be glad to answer any questions not related to banking if you guys have any. I guess, like I said, I'm 23. I graduated college recently, just moved into the workforce. If you guys have questions about the career paths, anything, I'm yours.
Walk through like what a career path at Stevens looks like and how to apply in that process.
Yeah. Well, you're in a good spot to begin with, Max. You can just pass your resume along to somebody. A career path at Stevens varies by department. So I'll use where I'm in equity research, for example. There's two main roles: an associate position, an analyst role. Each associate works under an analyst. You kind of do more of the lifting as far as the modeling goes, as far as the writing goes, as far as the data pools and everything goes, whereas your analyst is on the road. Mine's in New York right now. On the road talking to investors, meeting with investors, pitching stocks. Typically, if you're fresh out of college, you join as an associate. They want you to prove yourself before you kind of move up into that analyst role and you take more responsibility. The typical time frame is 3 to 5 years, and then after that, you're done. The only thing, you don't get moved up above to like a senior analyst role. That's it. You'll get a title change after certain time frames. You'll go from vice president, senior vice president, director, managing director, which is the top one. And that's a progression over time. But in equity research, you're capped out at an analyst role, and the only kind of progression you get is the value you add to your specific franchise. So like the bank franchise or my analyst specific franchise, which is totally variable across each team. It's a little bit different for corporate finance, and I don't want to act like I can speak to it too much. I know a decent amount about corp fin. You start as an analyst, you go through their 2-year banking program. I went through the application process, the interview process. It's strenuous. They cut, I think there were 2,000 people the year that I went through that submitted resumes. They brought in 75 for a super day. They hired like 25 guys, so 25 out of 2,000. Strenuous process. Once you get in, you're an analyst for 2 years. The hours are long, probably a little bit longer than equity research. You move up to an associate, or you leave and go to a master's program after that. They usually retain a few associates each year. But a big path is going to get an MBA after that, or moving into private equity. So you would move from analyst up to an associate, so the reverse of equity research. After that, your title changes to where you become like a VP associate, where you're and then senior VP and associate, where you're like a senior banker, then managing director. So that's, I don't know if that answered your question, I guess. As far as applying, honestly, I don't know. I don't know if I ever applied for a job there. I just sent resumes into people. That's the easiest way to get your name in there is to send a resume along with a great, well-worded message, get a connection with somebody. They'll usually, if you make an actual attempt to reach out to them, talk to them, ask them questions about the job, they'll usually pass your resume along to a superior or someone who is more active in the hiring process. That's, I think what I did, when I got a job, I called Tyler, I looked up his number on the website, called him, did a project for the team to show that I kind of knew what I was doing to an extent, not really in retrospect, but that I would at least put in effort to do this project. And then it was an eight round interview after that, so. Yeah,
What's been like your biggest transition from college to like working at Stevens? Or like the hardest thing you've had to like overcome, the biggest change you had to make?
the biggest change was the hours.
Uh-huh.
That's probably the biggest change. I don't know. You go from having class for 4 hours a day, you probably have a job where you work some hours a day. It kind of becomes your life, where I get there at 5:30 in the morning, I leave at 6:30 at night. It's what you do. That was one of the biggest reality changes for me. I guess one other thing would be and this is more interesting, you're very liable for mistakes that you make. That's one thing you don't realize in college. You can make a mistake and it's just a number off of your grade on your paper. When you're running a model that's influencing someone's investing decisions and you make a small error, you have to own up to that immediately. It's embarrassing if you have to call somebody or report to a superior, tell them that you made a mistake, but that's something that I learned very quickly that you had to do. You had to be honest about your mistakes. That's the only way you would get better at your job.
All right.